Welcome back to The Explainer, everyone. Today, we're diving headfirst into the alluring, highly profitable, but honestly, deeply complex world of leveraged single-stock ETFs. Specifically, we are putting a magnifying glass on a product called APU. Now, investing in these types of funds is a lot like looking at an iceberg. On the surface, the expectation is super simple. Just double the returns of a really great company. But just beneath the waterline lies this massive, complicated reality of derivatives, compounding decay, and some pretty intense structural risks. So we're going to uncover exactly what is lurking beneath the surface.
Okay, let's dive right into this, because I gotta admit, it's an incredibly tempting hypothetical. Just imagine you love Apple. You believe in their products, their ecosystem, and for sure, their future. But maybe traditional stock market returns just aren't fast enough for you. What if you could click a button in your brokerage account and effortlessly magnify your gains on Apple by 200%? Well, that is exactly the promise that draws so many retail investors toward leveraged single-stock ETFs in the first place.
But to really grasp how this works, we need to contrast holding standard Apple stock, that's ticker symbol AAPL, with holding the Direxion Daily AAPL Bull 2X ETF, ticker symbol AAPU. Buying standard Apple stock means you actually own a tiny physical fraction of the underlying business. Buying a leveraged ETF like AAPU, that is a completely different mechanical beast. You aren't just buying extra shares of Apple on margin. No, you are buying a highly engineered financial product that's designed to achieve a very specific daily mathematical target. Section 1. The allure of 2x returns. Let's start with that shiny surface layer of our iceberg, because the upside potential is undeniably real. And this brilliantly illustrates exactly why investors flock to AIPU. According to the data, AIPU posted a massive 100.13% one-year price performance. I mean, wow. If you caught Apple on a phenomenal year, AIPU did exactly what it said on the tin. It amplified those gains beautifully. Seeing a 100% return in a single year completely validates that initial excitement. But as we know all too well in finance, past performance doesn't tell the whole structural story. Section 2. What's actually inside AAPU? All right, time to plunge beneath the surface of the iceberg. When you actually hit buy on your brokerage app, what assets are you physically holding when you purchase shares of AAPU? Well, prepare for a bit of an aha moment. You might assume a 2x Apple fund is just stuffed to the brim with Apple stock, right? Actually, nearly 86% of AAPU's exposure type is sitting in cash, bonds, and other instruments. Only about 14% is classified as standard stocks. Now, what's really interesting about this is how a fund that is mostly cash actually gives you 200% exposure to Apple. How do they do it? Through derivatives. The largest holding is an Apple Inc. swap, sitting at over 130%. You've also got Dreyfus Treasury Cash at over 38%. The actual physical Apple Inc. stock, that makes up less than 10% of the whole shebang. So AAPU primarily achieves its leverage through derivative swap agreements, not by hoarding millions of shares of iPhones and MacBooks. Let's translate some of that dense prospectus jargon into plain English. This setup is called synthetic replication. Because the fund relies heavily on swap agreements, you as the investor are taking on what the prospectus calls counterparty risk. In a standard swap transaction, two parties agree to exchange returns. This means you're essentially relying on massive global financial institutions to honor their side of these contracts. Suddenly, your investment carries risks that are totally unrelated to Apple selling more iPads. If a counterparty fails to make a timely payment, the ETF itself suffers. Section 3. The daily reset trap. Counterparty risk is very real, but it's not even the biggest danger lurking here. Enter the mathematical quirk that happens at the end of every single trading day: volatility drag, or the compounding effect. Here is the absolute most vital thing to understand today. APU and similar funds only promise 2x returns for a single day. Not over weeks, not over months, and absolutely not over years. At the end of every single trading day, the fund rebalances to reset its exposure right back to that 2x target. When you dig into the actual mathematical models from academic literature behind these products, you see how they calculate those daily reset values. The fund's value is essentially determined by compounding each individual day's return. Because of this daily reset, the fund's long-term performance is highly path-dependent. In a steady uptrend, sure, this compounding can actually boost returns beyond a simple 2x multiple. But in a choppy up and down market, it causes extreme rapid decay. Let's move to a quick example and see how this builds in a real-world, sideways market scenario. Step 1. Let's say Apple goes up 10% on Monday. AAQ beautifully goes up 20%. Awesome.
Step 2, on Tuesday, Apple drops 10%. AAQ drops 20%, but it drops 20% on yesterday's newly elevated base. Step 3, by Wednesday, the underlying Apple stock might be virtually flat from where it started the week, but because of how that math compounds, the AAQ investor has actually lost money. Boom, that is volatility drag in action.
Section 4. Concentration and sector risks. We also need to pivot and talk about the broader systemic vulnerabilities here because you are concentrating 200% leverage on a single underlying technology asset. The prospectus fires off some pretty stark warnings about this. First up is non-diversification risk. Literally by design, this fund has all its eggs in one highly leveraged basket. Second is technology sector risk. Tech stocks are just inherently vulnerable to extreme price fluctuations, supply chain disruptions, and rapid product obsolescence. If Apple faces a sudden hurdle, AAPU amplifies that hurdle by a factor of 2.
Section 5, surviving the drawdown. Which brings us to the final, deepest layer of our iceberg. What actually mathematically happens to a leveraged portfolio during a severe market correction or a prolonged bear market? Well, when we look at academic maximum drawdown data plotting the years 2000 to 2025, it visually grounds all these theoretical risks into historical reality. When you compare a standard index ETF against 2x and 3x leveraged ETFs, the sheer depth of those leveraged drop-offs, the drawdowns, are genuinely terrifying when viewed on a timeline. So, the crucial point is how this plays out when things really hit the fan. Looking at the data from the 2008 financial crisis, while a standard ETF fell significantly, we're talking roughly a 45% drop, the 2x leveraged equivalent experienced a maximum drawdown exceeding 90%. It was nearly entirely wiped out. Think of it like a giant magnifying glass. Leverage is totally directionally agnostic. Yes, it absolutely magnifies the sun to start a brilliant fire of returns on the upside. But a market downturn will use that exact same magnification to mercilessly burn your portfolio on the downside. It punishes you twice as fast. And there's this ultimate hard mathematical ceiling to the risk here, stated as plain as day in the fund documents. We can call it the 50% rule. Because the fund resets daily, if the underlying Apple stock were to drop by more than 50% in a single trading day, an AAPU investor would lose 100% of their money, a total absolute wipeout. Now, while that's highly unlikely for a mammoth company like Apple, the mathematical certainty of the risk is written right into the DNA of the fund. I want to leave you with this direct and frankly kind of chilling quote straight from the prospectus warnings regarding these daily leveraged funds. It says, "The fund will lose money if the underlying stock performance is flat over time. It is even possible that the fund will lose money over time while the underlying stock's performance increases." That single sentence just totally shatters the whole buy and hold illusion, doesn't it? It really forces us to ask, is the temporary allure of double returns actually worth the mathematical certainty of decay if the market just goes sideways? Thanks so much for learning with me today, and as always, I highly encourage you to read the fine print before taking the plunge.